Okay, today's date happens to be January 13th, 2021, but the current date doesn't really matter that much. This is a look back at the past and coming up with a mining stock trading plan, and I'm calling this number one because maybe I'll come up with a couple more plans that are different than this. Um, I've got a couple ideas, so maybe I'll have two or three of these. Um, and I'm going to use the Huey index, which is a mining index, and you can Google that and look that up and see all the stocks that compose that. But I'm going to just say, on average, the Huey mining index will represent what I would have gotten, the gains I would have gotten if I'd just pick my own mining stocks. I may have done a little better or a little worse, just depending on the stocks that I picked. Um, and so that's and here's the plan. I typed it in just to save time here. Um, it's two parts. Buy and sell the UE index when the Dow Gold ratio chart tells me to. And the Dow Gold ratio chart tells me to buy August 9 in at the end of the month, August 1999, and sell August 2011. And that's real simple. I'll get into the details of the amounts. I'm just going to arbitrarily choose $100,000. And the second part of the plan is whenever I get in at this date, whatever the Huey is, as it drops, which I already know it did drop because I can't get in at the exact low. Nobody can do that. So I was a little early to the party, if you will. And so my plan would be to uh, be disciplined and not panic when it drops and buy more shares uh, anytime the UE index is below where I got in. And that's what the B part of the trading plan is. Let's see. And the main purpose for coming up with a plan like this, it might not be immediately obvious, but I believe it's to be prepared for the psychological consequences. I think that is an underestimated part of trading and or investing that at least I know I've missed out on it and not being aware that that's such a big component of trading is not panicking. So that's what I'm saying here. I'll just go ahead and read it. The main purpose is to be prepared for the negative psychological consequences of not getting in at the exact low, which nobody can do unless they're lucky, or of the negative psychological consequences of volatility. We've gotten used to steady results and not, like hitting 5, 6, 7, 8%, and mistaking volatility for risk, which they're two different things. Obviously, there's two different words, but let's go ahead and get into the calcs. Again, remember the chart is what tells me to buy and sell. That's all it does. And so let's look at that. And let's see, draw a highlight. So there's that August 1999 date, and that's what the Huey was. And it's telling me to buy. There's no mystery to this part of it here. This part's pretty easy. And in fact, let's just go ahead and do the calculation for this part of it. This is the major part of it is um, what I'm saying is that, one part of it is to take 100,000. Let's see here. Let me just format this whole row in currency. And I'll do calculations with dollars in this row. So I start with 100,000, and the Huey goes from 68 to 618. So my profit is therefore going to be this. Not my profit, rather my final results times this is going to be this times this ratio, the ending price divided by that. And so I start with 100 and I gain 809,000 for a total of 909. That's the main part of it, but that quick count doesn't show the emotional psychological part of it, and so I wanted to delve into that part of it with this part of the presentation. This is part B. So if we go back, so we just did part A. That was part A. That was easy enough. There's not much to. It's not very complicated. Now here, this is a little bit more complicated, and there's less results out of this, but this kind of highlights one of the psychological problems. And this is the live chart, which I may need. Let me go back over here, and I'll zoom you in on here. Here's the end of August, 1999, and it's right about there. And I'll draw your attention to this low point right here. That'll come into play, and there's the 68 that we started with. So we went, that's where we started, and we went from there to there, somewhere in there, very near the top, if not at the exact top. It kind of, sometimes this calls the top in the stock market, sometimes it calls the top or the bottom in the gold, and sometimes it gets neither. Like, for example, the Dow right here at this point, in August 2011, this was not the low in the Dow, but it was the high in gold, and I think it was pretty near the high in that. So it doesn't get both of them usually. But anyway, that's the big move, and here's the problem for another video. I think maybe I'll do this in the second video, but there's quite a big pullback, but I want to address that in this video. Let's save that for later. What I want to address is this, which is quite significant, even though it doesn't look like it on the graph, is the difference between there and the difference, excuse me, I'm free-handed here. The difference between there and there, that's what it's going to drop. Okay, so now let's go back to this is setting our expectations. So we started with 100,000, and this is what we're going to have to live through. So we started at 100,000. This just shows the big picture, which is no problem. From here to here, That's how much we gained. Now let's look at what we had to live through. Um, we had to live through it going from 68, and this is where I might need the live chart if I haven't. No, I think I got, yeah, I got that one. On 11/13, we dropped down to 36. So that's what we had to go through. And 36 right here. So what did our account go down to? Well, it before it went up to 908, it went down from 100,000 times this divided by this, which is nearly half. So it went down by nearly half. And if you remember, when it goes down, we're going to buy more. And we're going to buy more until, let's just go ahead and do that part of it, until it hits this point. So it did one of these things. We didn't get the exact bottom. It bottomed out and it went down. And from that point, which was 68, and to 36, and then it goes back up to 68 again. So that was 68, went down to 36, then back up to 68. See, I'll do it over in this area. 36, 68. I'm sorry. 68, started at 68. Well, these are all dollars. Oh, okay, that's because it's over there. Let's see. Let me just do it over here. I formatted that whole row. So we started at 68 and went to 36, and then we went back to 68. And just to keep it simple, let's get an average. So what it did was let's visually look at what happened there. I'll just pick that color. So it went down and went back up, and there's 36. So really, if you wanted to get an average, it wouldn't be halfway up in between these two numbers. It would be an average of all three of them. So let's find out what the average is. And let's just do it this way: equals this plus this plus this, and then divide that by 3. So that's where yeah, that's fine. So there's the average. So that's what we'll use. We'll use that average. And the trading plan was for each month we each month that is below it we're going to put $1,000. So we started with 100,000. We've already calculated that, and then now we're just going to assume we need to find out how many of these there are, and that is easy enough to do. we'll just go to the live chart here and get the dates. Already know two of the dates. I just need to find this third date right here. So we got in right about there, exactly there. And then, on average, I don't want to get into making this more complicated than it needs to be. It looks like right here, somewhere over in there, there's 65 and there's 70. So let's call it 1/7/2002. Uh, we quit buying. So we buy as it drops, and then once it gets above our number there, 68, then we quit buying. That's the trading plan. So we don't buy, any as it's rising, which that could be another trading plan. But in this trading plan, I start with 100,000, buy thousands at the end of each month that it drops below. If it doesn't drop below, we just stick with 100,000 and ride it out. So that's a trading plan. Okay, so I said 1/7/2002, and here's that date, 1/7/2002. And then the other one was, let's do it over here, 1/7/2002, and the other date is August 8/30/1999, and let's subtract those two and this will give the number of days. And then let's convert that to times 12 divided by 365. It didn't work. Equals this times 12 divided by 365. So format cells number. So this is 28 months. And so 1,000 times 28 is, this is days. It's 28,000. So our profit for this, or not our profit rather, but our final tally for this portion of it, for 28 months it was basically below 68. So every month it was below, we threw in 1,000 from our income, let's call it. Let's say by 1999 we had 100,000 saved up, and then with our income we decided to put it towards this because we saw this pattern, and we wanted to play this pattern, and be diligent and not panic, and buy when it dropped. And so we had to do that for 28 months. So we had to have patience. And so here's what if you remember, we got in at 57, basically, rather than the 68. And of course it went up to 618. And I know those say dollars. That's actually Huey. But so we end up with this amount times this divided by this, 303. And so our total is going to be the 303 plus the 908, and it's going to be $1.2 million. Now, that takes into account this drop right here, which is occurring over quite a 28 months, 12, 24. It's over 2.5 years. Well, it's 2.5 years, 861 days. So that's psychologically taxing right there. And the other part that's psychologically taxing is that our initial investment dropped by a half. And what we did is we had the discipline to buy. We bought another 28,000 as it dropped, rather than overreacting and panicking and getting out. And then once it rose above that point right there, we looked to other things to invest in this particular trading band. Now, obviously, the thing that I'm missing here is the psychological impact of this. So that would be another video, and not this video. So that's it. Again, like if you're trading or investing, and I'm calling a year. This would have been a 12-year investment right here. I'm calling anything over a year an investment. And, the worst taxes can be, I think, is 27% if you're in it for a year or more. That's long-term gains. No, I'm sorry. I think it's 20. And I think it's if you trade in and out more often than a year, your taxes are 37%. So I cannot predict. I can't predict this right here, and I'll go over this in another video. I'll address this thing, this big whopper right here, in another video. I don't think that's likely to happen again, and so that would be in the next video that I'll look at that. And here, this looks like it's not a big move, but if this chart had a log scale, I would click it on so you could see that that's quite a big percentage drop. Well, as we found, it doesn't visually look like that much, but that is a big drop to go through psychologically. And to have it happen over a period of time, just consistently dropping, it's kind of outside the norm of what a person would be used to. So, just to really wrap this up, I'll just freehand something here. We're used to, gains like this, steady, and maybe 5%, but this is something that the average person isn't used to, up and down, to get to a much better average return. You're going from there to there. So this is, I would say this is about 100, over 12 years, this is about the difference between making 100% return per year, at least, even with that negative, even with this right here. But a CD or a bond, you might get, this is not even recent, but you might have got 3, to 5% over this time period on average. But lately, it's less than 1%. So this is challenging. The volatility is challenging, but it's not necessarily volatility doesn't equal risk. Well, anyway, I'll wrap that up there, and maybe I'll have another one where I look more in depth into this one and why this is not likely to happen again. And the main reason is that this was the highest the Huey had ever been, and right now it's not that far off its low. So that's what's different between now and the 2008 crisis. It's not likely that there's enough room for this to happen again. So I'll finish up there, and thanks for watching, and good luck trading or investing, whatever you're doing.